This is Dentist Money. Now, here's your host, Reese Harper.
And welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, Reese Harper, here with my trusty old co-host, Sir Ryan Isaac. That's Latin and Spanglish combined with a little Italian flair.
For Isaac.
For
all those who already knew that. Or didn't know.
You have a lot of friends, and I think it's the funnest part about the show to me is introducing you in a tricky way.
Yeah, you keep it fresh.
Gives people a new perspective on the man, the myth, and the legend.
Okay, so I have a question this morning. Everyone listening can think about this question. Picture the last time you're laying in bed at night, and
that was actually last night.
Okay. Easy? No, but you got it. The last time you're laying in bed at night, almost falling asleep, and the little beep of a distant smoke alarm started chirping somewhere in your house.
Okay.
You think about that?
Yeah.
What did you do when you heard that chirping? What was your first instinct?
I put on my headphones and turned on the white noise app.
You did?
Yeah.
So you ignored it.
I didn't have time to get up.
Overhead and try to ignore it too.
I didn't have time to get up.
If you can't ignore it, what does everyone do? What's the default?
Just go pull the battery out.
You go pull the battery out.
Or you hit it with a small hammer. I do have one of those small, it's not a sledge.
Don't hit it with a small hammer?
You can.
You have like one of those.
It's a mallet. It's a mallet. A rubber mallet that you use for a variety of household chores. Doesn't damage the furniture.
Raise your hand if you've used a mallet for a variety of household chores ever.
There's 6 people in the studio and 5 raised their hand. You're the only one that didn't.
I've used a mallet once when laying some brick. So you got to cut the brick.
I don't believe you were laying brick.
No, I did.
Not yourself.
A patio, yeah.
You were supervising it.
No, I really did it. I laid a brick paver patio once.
And then you retired from manual labor.
Yeah, I did. I did it. Anyway, back to the smoke alarm. Most people go and they take the battery out and they just kind of be like, I don't know, we'll just replace it at some point. I have some statistics, but today we're going to talk about how ignoring your smoke alarm and taking the battery out is like your retirement plan. That's what we're talking about today. Obvious connection, I know. But check this out.
Let's pivot. I like it.
Okay. Well, the story also brings up a really emotional point for me, which is the show This Is Us.
Yeah.
And if you've seen it, right? Are you caught up?
I'm a little behind, but I remember. I think I was the one that originally told you to start watching it.
And what did I say? I
said I hate crying.
I don't want to cry. I know it's going to be so emotional. I don't want to go through that. I just want to watch something funny at the end of my day. But I watched it all, and it was hard.
Since you cried during the entire day, you didn't want to cry at night.
Yeah, basically. It was such a good show. For anyone that's listening that hasn't caught up on This Is Us, I'm just going to say push pause or skip ahead 30 seconds because this has something to do with it. Let me read you some stats here. 3 out of every 5 home fire deaths occurred in homes with no smoke alarms at all, or they had smoke alarms that did not work. So 3 out of 5. No smoke alarm, or they did, but it wasn't working. The death rate per 100 in home fires was doubled in residents with no working smoke alarms compared to ones that did have it. Okay. They also found that in 46% of the fires when a smoke alarm didn't work, it was due to a missing or disconnected batteries. And dead batteries entirely caused 24% of the smoke alarm failures.
Wow.
It's this battery thing. Okay. Dead batteries caused 1/4 of smoke alarm failures. So this month is our qualified term month. It's part of our elements. It's in the bottom row. Maybe you can explain a little bit about the bottom row.
Well, I'm still stuck on this fire alarm business.
Ask away.
Are you just saying fire alarms they work, but we don't take care of them?
The point is that fire alarms represent something that we should pay attention to or have some kind of maintenance on.
So they matter.
They matter. Well, that's what the point of the stats. A non-working smoke alarm is responsible for a higher percentage of deaths in fires and house fires. It's something we should pay attention to, but normally we don't.
Because it's annoying.
Because it doesn't feel like an emergency or a priority. And usually it chirps in the middle. It never chirps in the day. Has it ever chirped in the day?
Never.
It's never chirped in the day.
It
only
knows
chirps at
better.
night. It knows it's nighttime. Chirps at night. We remove batteries and we don't put them back in. Hence the show This Is Us. They were supposed to buy the batteries. If they would have bought the batteries, we still would have had Jack with us. And I wouldn't have cried so much.
Spoiler alert.
I already said that.
The real issue, you could also have said Jack worked at a smoke alarm manufacturing plant and not gave away the analogy.
No, it's so deep and painful to me.
It's rooted in your psyche.
But this is the month. It's on the bottom row of our elements, which in our bottom row, you can go to our website, dentistadvisors.com, hover over services, click on elements. In the middle of the page, you'll see a big elements table. The bottom row is where we talk about somebody's net worth. Where are they accumulating assets and wealth? Is it liquid? Is it retirement plans? Is it private businesses and practice? Is it real estate? And what we're measuring in this month is how long could someone survive? How long could they live if they took the money in their qualified retirement plans, which are IRAs and 401ks, paid the taxes, and then kept spending how they're used to? So what we found when we went through this data, we have some cool statistics from our own client base, is that retirement plans, and we find this when we meet dentists we haven't worked with before, retirement plans are often like smoke alarms. They're things that you kind of just like put in place once and often ignore for years at a time. And sometimes we pull the batteries out and it kills us. That's a pretty direct correlation, I think.
Yeah.
Yeah. Anyway. Okay. So how about you explain just a little bit on why do we measure this? I have some. Do you want to go through statistics first? Because I have some cool stats from our clients.
I'd actually be interested in hearing those.
Okay, let me tell you these, okay? What percentage of someone's overall net worth is tied up in retirement plans? Here's the averages for the age groups. And this is what's kind of interesting. Up to age 35, it's 12.5% of someone's net worth is tied up in like an IRA up to age 35. Then it drops to 8.9 between 36 and 40. So I think what you see is what happens when someone comes out of dental school is usually the only thing they have is like an IRA that they put some money into. Or maybe they had an associate job or a spouse had a job where there was a 401k plan. And that's like, there's no other liquidity. They don't own a practice. They might not own any real estate. So
yeah,
it's a fair amount. But then it drops ages 36 to 40 and then starts building back up from in your 40s at around 11% into your 50s at almost 12%. And then it jumps at age 56 and above to 19% of someone's overall net worth. So the average person over 56 years old has about 20% of their net worth in retirement plans, up from 11 at 55 years old.
Mm-hmm.
So,
and just a clarification, when you're saying that many percent of people, you're talking about dentists, and more specifically, we're talking about the dentists that we work with.
Yeah, I'm saying the dentists we work with up to age 55 have about 11.6% of their net worth tied up in retirement plans. And then 56 and above, it's almost 20%.
Yeah.
So I think this goes to the point that we talk about where people have the best opportunities later in their career to add more money to bigger retirement plans. You know, so at some point in your 50s is when big profit sharing plans and pension plans and cash balance, that's when it makes the most sense. Usually someone has the highest cash flow, their debts are gone or mostly gone, and they just have a bigger opportunity to pile a lot of money into. So it was just kind of cool to see the data confirm what we'd like to happen in someone's life, where they spend early part of their career building their practice, building liquidity, and then take advantage in that last decade of piling a lot of money into qualified plans to save on tax rate, because that's the best chance.
That data is confirming the advice that we're giving people, probably not the general population, maybe. I mean, we don't have average data across all of our listeners, but in my experience, like in the past couple of days, I've had conversations with people in their mid 40s to latter like 46 to 47, 48, where their retirement plan contributions have shifted dramatically as early as 45 years old.
You mean like, what do you mean dramatically shifted dramatically?
They've gone from putting $5,000 to $16,000 a year away in 401k to where they're putting $160,000, $170,000 plus away. Now, if they waited until their late 50s, they could do even a little bit even more. But I think you want to start maximizing. The only reason that you would want to delay your larger retirement plan contributions is if you had also delayed all of the early savings from 35 to 45. If you didn't save after-tax money early in your career and you didn't have a lot of liquidity outside of retirement plans, then you kind of have to play catch up. And what I'd say is I'm hoping that more people start to shift more of their net worth towards qualified plans. In our reporting here, it was saying late 50s, and I'm hoping to get that to more the early 50s for high income individuals, and for the average, maybe average income earner, it'll probably still be mid 50s, just because of, the more you earn, the more you can accumulate in your early years in after-tax monies. And really the goal here is to try to find a nice balance between the two, not accumulate too much in qualified plans and not accumulate too much exclusively in after-tax assets. But man, it's been the last few days just getting like texts and emails and phone calls with people who are like, man, that really made a difference in my taxes. Because right now we're doing these contributions for 2017 in big DB plans, like finalizing our contributions after we've extended taxes. And it's, it reduces taxes by tens of thousands of dollars. In some cases it's been as high as $80,000 or $85,000. You know, it's significant. And I'm not saying that'll happen with everyone, but the higher your income is, the more impactful it is. And this analysis of retirement plans is crucial.
Yeah, I thought it was interesting just to see that kind of where averages end up, and where, towards the end of someone's career, what can you expect? How much of your net worth is going to be sitting in one of these plans? Because part of this equation too is what happens after this. The other 30 years you live after working, when you access this money, you have to pay tax on it. And so the balance of when you take that money and how you do it in combination with other things, that matters a lot to your planning and matters a lot to your investment returns, your investment plan, right?
Yeah.
Another thing I thought was interesting too from the data was what percentage out of all the investable money someone had was in qualified plans. And for most age groups, it was like a third for most age groups, except at the end of, again, the above 56, where that they're kind of just loading these big plans at the end of their career.
Yeah.
Now this changes though when someone sells a practice for $1 million and then dumps that back into after-tax liquid accounts. That will kind of balance things back out. But
yeah,
kind of interesting.
Yeah.
Okay, so here's what we'd like to get into today. I have a list of questions. So as we ran these reports and we reached out to all of our clients and we talked to them about the plans they have and adjustments they could make, and then we got questions back. Today is kind of a list of some of the most common questions we were asking and that clients were asking us when we were going through these plans. And this is kind of like how the smoke alarm is like a retirement plan. You just said it. It makes a big difference. I've been telling people that the retirement plan is so important because it's one of the most like proactive, consistent things someone can do for their taxes on an annual basis. Like there will always be like a one-off purchase, or like a tax code thing that you can take advantage of, or maybe there's a bookkeeping thing that you do in 1 year, or some kind of depreciation, right? But the retirement plan is the most consistent, proactive thing that you'll be able to do for your taxes every year. And like the largest, would you agree? Is there something bigger and as consistent for a tax deduction that you can do?
Well, the advantage of it over everything else is it still ends up being in your net worth. It's not money that leaves your net worth. Where
it's not a purchase.
Yeah, the thing with a lot of the other tax planning tools or deductions or expenses is that the money leaves your net worth. So, your net worth is reduced. Even though you saved taxes, your net worth goes down because the cost of the expense exceeds the tax deduction. So the 401k, the retirement plan, the cash balance plan, the profit sharing plan, any retirement plan contribution you make, not only does it increase your net worth by the amount of the contribution that you're making,
right,
but you're also getting an additional net worth increase by having taxes deferred and you keeping more tax in your pocket. More cash in your pocket because you didn't have to pay those taxes, and you can defer it out into the future to hopefully a point in time where your income is lower to where that same tax burden doesn't exist at the same rate,
Yeah.
which is likely. So,
Okay. All right. So let's go through some of these questions that we've been asking clients and that they've been asking us. The first one is kind of a more general one, and it's what can actually change in a year? Why look at this on an annual basis? If I put a 401k in my practice, I mean, what's going to change in a year?
well,
Some thoughts.
I think your taxes change quite a bit in 1 year, meaning you might not have the same tax rate you had, and so there's reasons for people in the early phases of their career to look and make sure that you still want to be doing tax deductible contributions instead of Roth contributions into your 401k. If your income shifts a lot because you have a bunch of depreciation, buy a building, do a cost segregation study, and amortize things aggressively for a few years, you might want to shift your contribution strategy because your taxes are already super low. Why not take money in those years and put it towards Roth contributions instead of deductible contributions if your taxes are already super low?
Sure.
Another thing that is a big deal is staffing can change so much year over year that you could have entirely new options year over year.
You want to explain that a little bit?
So every time that you do a retirement plan analysis, you have to look at the ages of your staff, what they make, and the hire dates that they've had. When you have and a new formula can be determined to decide how much money you can put away. And the demographics of your practice affect how much money you can put away for yourself versus how much you have to share with your team, or how much you get to share with your team, depending on how you look at it.
Mm-hmm.
And so if as you age and as your staff ages, the contribution formula is very different than it was the previous year. And it might be as little as you can get an extra $5,000 to $8,000 away by re-looking at it year after year. Or it could be that, like in the case of one of my clients this year, it shifted from, to where it went from making sense to put away $32,000 the previous year to where this year we're putting away $188,000.
That's
in 1 year.
$150,000 difference at a 35 to 40% top bracket rate.
Yeah. Well, almost 50% in this guy's case.
State. Yeah.
With state and Medicare surcharge, and so it's hugely significant. And if I'm not there testing that every year and looking at it every year, what ends up happening is it just doesn't get reevaluated.
It's the smoke alarm, man.
Yeah.
And then you're going to die.
Yeah. And most 401k administrators and most 401k platforms, there's not like a built-in incentive for them to go do this painful testing every year because it costs a lot of money.
Well, and you have to do it twice because at some point during the year before it's too late. So any changes you have to make to your plan officially, the deadlines are in the fall. They happen in September and October. So you have to run it early enough in the year to go, yeah, we're probably going to want some kind of change, and that might require an actual plan structure change that is due by the fall. Then you have to do it again at the end of the year to get the official end of year number when payroll is done and everyone's hours are finally done and all the new hires. Yeah, so it costs money and it's a pain to do.
So I mean that's
hours
why
of work.
Yeah, our clients that are in our elements process, they're paying us to do this analysis once a year proactively in June so that we can determine
May.
Well, actually, we're doing it in May, and then we're reporting on it in June a little bit, aren't we?
Yeah. Spills into June.
Yeah.
Because, again, it's hours of work.
Yeah.
Yeah.
Well, and by the time, maybe it's because all of my personal clients aren't responding to me until June. That's why I'm thinking it's June.
Everyone's on vacation.
Yeah. So ultimately, I think if you're not analyzing this, though, mid-year, you can't really prepare for like right now in the middle of the year. See, you're kind of if you're in defined benefit plan mode, you're still you've had to wait until all your census filings were complete.
You're still funding for 2017.
You're still funding for 2017, and you're preparing for 2018, and so it be. Usually what happens is people don't talk to you about this until it's too late for you to plan this from a cash flow perspective.
Yeah.
Because no one wants to have to be told in December that they've got $100 and something thousand deduction they need to make to fund a plan
in order to keep their taxes low.
Yeah. And so I had a question that came in yesterday from one of our clients who's doing a large defined benefit plan contribution. He's like, man, cash flow is a little bit tight right now, but I definitely still want to take advantage of this deduction. What can I do? And we figured out a plan to where we could took some of his after-tax money and out of his, because he had been saving really good for the last 7 years in after-tax assets. He had, and I was able to take some of the money out of that account, liquidate it in a tax-efficient way so he wouldn't pay a lot of capital gains taxes, and then transfer it back to him personally. And then he was able to put that money into his practice.
Pay himself.
And then the practice made the contribution into the defined benefit plan.
Yeah.
So because he had been consistent as a saver and we had a high savings rate, even though he didn't want to take this whole contribution from the practice to fund the defined benefit plan, we still had ample amounts of liquidity in his after-tax account that we just transferred from after-tax to pre-tax.
Yeah.
And ended up getting the same tax
that's a
deduction.
good point, man. I mean, I can think of quite a few clients that are doing either profit sharing or defined benefit or cash balance. And if you know ahead of time, if you have enough time to know like that you're going to fund $100,000 into a plan, like you just said, you don't want to wait till December or next March to do that. It'd be nice to, now you don't want to overfund the thing, because you don't know how it'll grow and you don't know what exact end of year funding. But if you can say, on average, I need to put in $8,000 a month through this whole year to fund my profit sharing, I'll put in 5 just to underdo it a little bit, and then I'll just catch up at the end. That's way better. Yeah. If you can plan ahead for that stuff.
It takes a lot of planning. Yeah. I mean, it takes a really proactive financial advisor to understand how to invest the money properly. It takes a good actuary who can get numbers to you in a timely manner. And then it takes a good platform to be able to execute the trades, give you good investment options.
Yeah.
I mean, a lot of times people end up going with what I would like to call like the cheap 401k option.
Okay, so this is the next question is, what's the difference between like 401k providers? There's thousands of them out there.
Yeah, like
does it matter where I set up my 401k?
Go on that. I just got a spreadsheet from somebody the other day that had columns in it.
Whoa.
And it was like, I'm like,
shout out to that guy.
Shout out to column guy.
401k column guy.
And I'm sure there's a few of you listening who are like, I'm column guy, created columns.
That's awesome.
But in these columns, there was investment fees, annual fees. Like they were trying to compare 10 different 401k providers
on cost.
And the cost was all within like,
$1,000.
It was all probably within $500, each. Yeah. There's 10 platforms. And you could tell from his analysis in the spreadsheet, he was just trying to find the optimally low cost option.
Yeah.
Now the challenge with that is for a platform to be the optimally low cost, it also has to have the optimally low amount of staffing, the optimally low amount of service, and the optimally low amount of customization.
And only the youngest employees.
And yeah, I mean, what I'm saying is the platform that you choose, if it's cheap, it's because the service isn't like, there is very little service. And meaning, why do you care about service? You care about service because you're not just going to have a straight 401k plan your whole career. There's many variations between IRA, 401k, profit sharing, and defined benefit plan. There's, dozens of variations that you want.
Ways to test it, to figure out contributions for you employees.
Different matching outcomes that you want to test. And if you don't have a good service provider there who's getting paid enough to do testing with you and to be around when you want that testing done, you could sit for 6 months waiting for data to come back. Yeah. And that's happened to us many times with the wrong providers, wrong platforms. And so it doesn't, if you're trying to just say, what's the optimally low cost 401k plan? Because you're never going to do anything but a 401k. That's very different than if you're saying, I'm going to be on a glide path of a variety of plan options from Roth 401k clear to cash balance pension and straight DB.
Yeah.
And there's 5 to 7 different plan types. And I just want to always have the most optimally tax deductible option for myself throughout my entire career. Well, that's going to require a very different platform because most 401k platforms don't even have any integration or any communication with defined benefit plan providers. They're like completely separate. And so it's difficult to sort of pick the right platform. For us, it's not perfect. It's still a challenge, and we feel like we have really, really excellent platforms on both ends of the spectrum, but it's still challenging. But it's not the cheapest option that gives you the most customization, because the most customization means that every plan has to get tested independently every year, and no plan looks the same. No plan has the exact same investment lineup, and no plan has the exact same matching formula or the exact same census or the exact same requirements. It doesn't. You don't even have the exact same payroll providers.
Yep.
It makes it harder to integrate properly. So, if you conform to the lowest cost 401k plan, you're conforming to the most I don't want to say it's the least restrictive, but it's got to be restrictive for the platform in order to charge so little.
Yeah,
which means that you're not going to be able to get the level of customization you want. And so that's why for us, I guess we just want to encourage people to understand that not all qualified plans are created equal, and not all qualified plans take on the same level of responsibility, which is a whole different topic.
Well, I was going to say, so you hit cost, which I think is great. Investment platform, your ability to choose between investments will vary quite a bit. Tech and ease of use.
Yeah, by investments, I mean, some plans have a straight mutual fund lineup. Some have a mutual fund plus ETF lineup. Some have an unlimited investment flexibility where each participant can have their own personal account and trade any stock, any bond, any option. I mean, you can have a lot of flexibility within a 401k platform, or you can have a lot of restriction, and you just want to know, what does your plan allow? And what rules are you setting up for your plan?
Well, and on the cost thing, here's what's interesting though, is it's not usually as straightforward as people think it is. There's 4 or 5 costs. Some of them are small costs in a 401k, but the big ones are you have an annual fee you have to pay. And usually if that annual fee is on the smaller end, it's because the other fee that is being charged in a 401k plan, not from your advisor, but from just the 401k platform, is the percentage fee inside of the account. And usually it's kind of a game in the industry, right? Because usually a 401k company will say, we know we're going to be on the smaller end of the market for a long time, so we're going to maybe charge a higher annual fee up front, like out of pocket, and then smaller percentage fees. Or it might be the reverse. They might know that we're going to be in large plans, kind of our market's going to be large plans, so we'll lead with a smaller annual fee but a higher percentage. And you kind of there's kind of a game between that. Right?
Yeah.
It changes. Here's what I was curious about though too, if you want to talk about it, is there's a whole side, what you were just saying, to responsibility back on the doctor's shoulders of, if it's really cheap, the service and the responsibility, but then also the fiduciary responsibility.
Yeah.
So if there's any problems or, a lawsuit or something in a plan, you want to know, like, where does that where does the responsibility lie? Who's it with?
Yeah.
Is it the provider that'll take everything on? Will they answer all of your employees' questions? If an employee wants a loan out of their account, if they want to just take all the money and cash it out, who's going to handle all that stuff? Who's going to file the paperwork? But, ultimately, who's responsible for, like, if there's errors or any legal problems or anything.
Well, legally,
and you'll pay more to offload the responsibility and the fiduciary liability. You'll pay for that.
The fancy words for this are, you have like 3 or 4 different formal responsibilities that have to be handled in a plan. There's a 316 fiduciary, there's a 321 fiduciary, and a 338 fiduciary. And each of those roles, in most cases, the doctor unknowingly is assumed all responsibility for each of those roles. So you're ultimately responsible for the investments that are in the plan, the proper filing of the plan, and then the compliance of the plan.
And notices to employees and the proper training to employees.
Yeah, and usually you just don't know that.
Yeah.
So usually the 401k plan you're going with is they're just holding the money for you, but you're responsible for all of the liability. And if you don't do it right, it doesn't matter. The plan's not responsible for you not doing it right. Some plans will say, we are the 316, we're the 321, and we're the 338. And that allows you to just have no legal liability regarding to the Department of Labor regarding your 401k plan. And that's worth paying for in some cases. Everyone has a 401k. But some of these 401k platforms and plans do the thing you want it to do. What you want it to do, if you're like me, I might just be the lazy one here, but if you're like me, you just want it to work really well and do its thing, and you want them to tell you when to do something, but you just want to have to like click a button.
Yeah.
You don't want to have to
or
do a lot.
tell someone else to click a button.
You want to tell someone else to click a button. Like this thing runs itself and I'm not worrying about it.
Yeah.
I'm getting the maximum amount of tax deduction every year. People are telling me what to do, where to put the money. I literally just tell them to draft my money, and it's more autopilot. And if it's not that, then to me you're not getting the same thing that I'm getting, because I'm getting the autopilot version that gets my maximum amount of tax deduction. Someone else proactively is monitoring it, taking all the risk and responsibility, and that does cost a little more. But I don't care because I just want my time back.
You have other things.
I want my time back, and I just want to dedicate my time to more productive activity. And there's just a cost to doing it the right way, and I just want it done the right way.
Yeah.
You want the outcome of a maximally reduced tax rate personally, and putting the most money you can away at the best ratio between you and your staff.
Based on the year that you're having.
Based on that exact year and
Yeah.
all these factors. And so there's a cost to doing that.
Yeah. What about, this is kind of along the same lines, but we hear this frequently. Should I just use the payroll, or should I just use the 401k that comes with my payroll company?
Yeah.
Yeah,
So
you get that a lot. Like, it'd be easier, Reese, if I just used the payroll company's 401k.
Yeah.
How many clients have we had that used payroll company 401ks and then didn't, like, a year later?
Yeah.
They were like gone.
How many of you have built a house and then the builder said, just use our XYZ, use our
lender.
Use our lender. You're like, okay.
Sure.
I mean,
that's convenient.
it looks like a good deal, and it might literally be.
It might be fine.
But there's something going on there that at least you want to know about and figure out a little bit more. So all I'd say
You'll
is
trade something for that convenience.
something's getting traded.
Yeah. There's a cost.
And it's usually a poor construction job on your house. Just kidding. Because they only make money on the loan and they really don't care about the house construction. I don't know. We'll see, right? It's hard to know. Okay. But ultimately, something's got to give when you're getting a twofer. When I was in Santiago, Chile for a few years in 2003, I always bought myself a twofer. Now, a twofer was literally what they called it in Spanish. It just literally said two, F-E-R on it.
Oh, really?
Yeah, and they took pieces of yellow tape and they wrapped it around two objects, okay? And they would call it a twofer. And you'd get anything you wanted. It was a twofer. There's Oreos as a twofer. There is any number of food objects. But the thing that I thought was most interesting is there's stereos, boom boxes for your shoulder, wrapped up in yellow tape with a twofer around it.
What did it come with?
It's two boom boxes.
Oh, two boom boxes?
Yeah.
Oh.
So everything.
Oh, there's like boom
one-
box and Oreos.
That's one for each shoulder. Yeah.
Yeah. And so you'd get a
stereo.
twofer. Now, there's always a catch to the twofer, though.
One doesn't work.
And you never knew until you got it out of there.
That's a good point.
And a lot of times the twofer cost more than the one-fer, but you just thought it was a good deal. So I don't know. I just don't like bundles.
Well, that's fine. So the short answer to, and it's a common question, should I just use out of convenience the 401k that comes with my payroll? The short answer is no.
No, the short
Probably
answer is
not.
probably not.
Probably
for sure
not.
But I don't know.
Talk to us. Call us. Okay.
There's a couple of platforms where I'm like, that one actually is pretty decent.
Based on the things that we've already talked about.
Yes.
Yeah. So if you want to know if your platform is good, you can text us. You can call the 800 number is cool because you not only can call it, but you can text it. 833 DDS plan.
Yeah.
Shoot a text.
You know,
We'd love to text you.
I'm going to tell you just in 30 seconds the philosophical reason why the twofer is usually a bad deal.
Let's go back to it.
Okay? Why your 401k and your platform is probably
And
not a
your
good
payroll
idea.
platform. Okay.
Because every business has to make choices about where to put its resources. Okay? And if it makes money on one thing and subsidizes or gouges in another area, right? It's all one of those two products is going to suffer, right? So if you've got a twofer and you've got a boombox wrapped up with a shovel, which I did see, then one of those two things is probably subsidizing the other one. Either the boom box is mediocre and you're getting a high quality shovel, or the shovel is mediocre and you're getting a high quality boom box. But there's a reason. You don't know. And I'm just saying, in the 401k, it's like classic. You've got the payroll and you've got the 401k platform. And one of those is going to win over time. Like whichever one ultimately is the biggest money maker for the company, like they're going to reinvest profits in that one and not in the other one. So the service that you thought you were going to get that was a good option will eventually get less profit resources reinvested back into it, because it's just not the thing. And eventually it'll just disappear. And that's what usually happens is you got this 401k platform by the payroll company. They make all their money on payroll. They're just trying to get more margin. So they try to add a 401k platform. They realize that they can't run it as properly and it requires a whole another set of infrastructure. And so they just quit offering it or quit supporting it.
You've talked about this in some of the live events that you've done in speaking recently, but the question is kind of how do you build a right mix of assets between qualified and non-qualified? So one of the measures in our report during QT month is this little bar, and it's got two colors on it. One of them's gray, one of them's purple. The purple represents how much of your money is qualified, and then the gray is all the rest of it, right?
Yeah.
And what we're trying to do is every year we're looking at someone and saying, basically, out of all the money you have, here's the mix between after-tax and pre-tax, and there's consequences on either side of that. So the question is, how do you know what's the right mix? You know, we kind of have a general rule of philosophy when someone's setting up their first savings draft. Someone's got 10 grand a month to save. As a general rule, like a starting point, let's say, like, let's try to keep things balanced, 50-50 balance. If we go one or the other a little bit more, that's okay. But how would you explain like how to keep a right mix of assets between those two, or a good balance?
I think a simple way of thinking about it would be just early in your career, you should be focused on building money outside the retirement plan, except at maybe a minimal level. So like most people listening to this are going to be able to afford to put money into a 401k and then save some more. And I would just say have some left over. Right. And as long as you've got more left over than what you're putting into the 401k,
or at least as much,
then I think you're probably fine doing the 401k. If you don't even have enough to do that and save extra money comfortably, then I don't know that you should be doing the 401k yet, unless you have ample reserves already. Like you've got maybe 2 times overhead, 2 months worth of overhead in your practice, plus 6 months of living expenses personally. Then maybe if your taxes are going to be high and your income is going to be growing, then you could break the rule for a short period of time because your income is going to be growing soon. But I think ultimately you just want to focus on the liquidity early and don't get obsessed about the 401k to the point where even if you passed on it for a year or two and paid down some high interest debt that was very truly high interest and that was small balances, not big balances. Don't just take a chip at debt, but like if you had some small, like high balance loans, I think that's more important than
some tax savings.
If
they are, high interest rate loans.
Initially. Just because your tax rate's probably not that high in the early part of your career. The right mix, though, later on, I mean, like you were saying, it's pretty hard statistically to get to where people have more than a third of their investable assets in 401k anyway.
Even that last push at the end of career. It doesn't.
Now, if you push really hard there in your mid 40s and you go for 10 or 12, 15 years putting money into one of these larger plans we're talking about, you might be able to get up to a 50-50 mix. But I see a lot of, if you're just the average person not planning, I see these are our clients we're talking about that have a third, because we are pushing after tax savings like crazy. As a priority. But most people, the only thing they have at the end of their career is a 401k. And for the average American, that's normal. I mean, that's a normal thing for the average person at the lower, we'll call it the median income spectrum. You should probably only have money in a 401k because you didn't really have enough after-tax discretionary money to start building up money outside the 401k, and your income's not going to be dramatically it's not going to be dramatically higher in retirement than it was during your career. And so it probably, the reason a dentist, it's so important for a dentist to build after-tax assets is because your standard of living is so everyone's standard of living is based on their income, and you're used to spending a lot more, and you have to accumulate more in after-tax assets to support the standard of living that you're going to want to have. And that's why we see dentists retiring so late. They just don't accumulate enough in order to keep the same standard of living. So they'll just keep working and let that Social Security benefit defer and kick up to its maximum. And then really the average person then will retire.
Well, I think that's a lot of it though too. A lot of it's based on income. The average dentist should have more money than can even fit in a 401k plan, even if you put a spouse on payroll. Mm-hmm. So, and that's just where like it's got to go somewhere else, and you want to maintain a good balance over the course of your career.
Yeah, I think the optimal balance is never miss any possible tax deduction that you can get ever, as long as you're saving at least that much outside. Yeah. Right?
Yeah.
Until you're at the point where it's okay at some point, probably in your mid 40s to late 40s, in some cases early 40s, but I'd say it's more likely to be late 40s, when the demographics of your practice has shifted and you already have a lot of after-tax assets, then shifting to a straight DV contribution where your contributions go really high.
And like every penny you have is going in there.
Then I'm fine with that, because you'll never really be able to catch up to that total mix of assets anyway.
Yeah. So I was just going to say, I was just checking this out on our website. We did a podcast. It was not too long ago on, maybe Justin, you can help me find this. It's the title's like Everything You'd Want to Know About Retirement Plans.
Yeah.
What we did on that episode is we broke down how to know what retirement plan is probably most appropriate for you, or at least where to start looking based on the amount of money you have left over every month. Because that's really what we're saying. Like, for example, it costs about $1,500 to $2,000 a month to fund one person's 401k, including match, you know, for a whole year.
Yeah.
So if you want to have balance, if you're trying to maintain an approximate 50-50 balance, that means you'd need $3,000 to $4,000 a month to be able to do a 401k, max fund it, and then have some money outside of it too.
Yeah.
It doesn't do much good to like do a little bit there and then pay the cost of having a 401k when you're not even going to max fund it or take advantage of it fully, or put everything you have and not anything outside of it. So that was, I think it was called Everything You Need to Know About Retirement Plans.
Yeah, so that's episode 53 for those who want to check that out.
To kind of pose an opposite example for some of our listeners who are at the extreme other end, in a lot of cases, you'll have people who are saving, like in this case of the person a few days ago, it's north of $20,000 per month going into after-tax savings.
Yeah.
That then is shifted almost entirely to pre-tax at the latter part of their career.
But what is it? How old is he? What is his situation?
Now we're in our late 40s.
He's 7 figures liquid after-tax money.
In after-tax money, and we're probably 25% in pre-tax.
Okay.
And now we're going to shift
super healthy
to where we go all pre-tax and probably end up at more of a 70-30 to 60-40 mix of pre-tax to after-tax at the point work is optional in the next few years.
Yeah, but that's totally healthy because he's got a large amount in after-tax, and he'll sell a business that'll be debt-free or almost debt-free when he sells it.
Yeah.
And so, which will translate into after-tax anyway.
Yeah, but it's just interesting to see how it's like, it's not, to him, it wasn't a big deal to make this transition. It was just like, we've started early in our career with a high savings rate. We've gotten the habit of saving a certain amount of money automated every month.
Yeah.
And then all we're doing is periodically every year, I'm just shifting some of that savings that used to be after tax. I'm saying, okay, this year, instead of having X amount of after tax and 18,000 of after tax and 4 of pre-tax, we're going to go 15, and 7.
Yeah.
And now we're going to go, 10 and 12.
But it's totally balanced because of the way he did it in the beginning of career. And now, the tax savings on that, then what does he do with then there's liquidity left over sitting around that would have gone to taxes.
And we can either use that new tax savings for debt reduction on his second residence that he bought, that's finally his family vacation property, or you can use it on additional after-tax savings to build up your retirement liquidity as well.
Keep going more. Okay, so to recap this, Reese, is there any kind of main takeaways as you went through with your clients this month and gave them feedback. Any takeaways for someone who maybe is not monitoring it this closely? Any advice or?
I would just say that
Parting words of
retirement plans are a 7-figure decision easily in net worth that you're making by avoid. Like if you're
Yeah, I
not
agree.
proactively doing this, we're talking easily. This is a 7-figure mistake that you're making by just saying, you know what, I've got my 401k. It's good. I'm fine. Like by not being proactive and letting your 401k plan advance and get more complex to allow you to put more contributions away. For the average person, there's some of you who own a multi-practice DSO and you've got way too many employees,
I was just
way
gonna
too many
say this.
locations.
There's a segment of this that it just doesn't apply.
Yeah.
You can't participate in it in the
And
same way.
the only reason you're doing a 401k plan in those situations is to provide a benefit to your team.
Yeah.
And in our business, that's more of the case in our own company. Like I don't have the ability with the way our company's growing and the way our demographics are. It just doesn't make sense for me to use my qualified plan as a place to where I'm going to be able to take advantage of it like most of our listeners will.
Yeah. So there's some people listening with multiple locations and 30 plus, 50 plus employees.
Well, you can do it on even as many as 2 to 3 locations. Depends on the staff mix. And I'm doing it right now with a multi-location practice with several associates.
Mm-hmm.
It's just you have to get the associates on board, and they have to be willing to take a reduction in their associate comp in order for them to get the higher retirement plan contribution,
which is not fun.
No, but they want to do it because they're paying taxes anyway.
Yeah.
So it still can be a win-win, but the bigger you get and the more employees you get, then all the stuff we're talking about, it still applies, but it applies at more of a minimal level, right? You're just going to do the deferrals, the minimum deferrals, rather than trying to maximize your plan contributions.
Okay. On our website, this is one of many discussions we've had about retirement plans. We've had guests, retirement plan experts, CPAs come on the show where we've talked about this. If you go to our website, dentistadvisors.com, and click on Education Library, you can scroll down and then filter for retirement plans. And there's probably like a dozen plus episodes in there if you have more questions. If you would like to talk to us about your situation specifically, you can call us at 833-DDS-PLAN or text us, because that's cool. Or you can go to our website and book a free consultation. So go to dentistadvisors.com, click on, does it just say book free consultation? It's a big button right on the front, so it should be pretty easy. And you can pick a time on our calendar, and we would love to hear from you. So thanks for joining us today, and we'll see you soon.
Carry on.